Welcome back. In this video, we will discuss what is market capitalization, how is it calculated. We will also discuss what is enterprise value, how to calculate enterprise value, and where is enterprise value measurement used. Let us start with the market capitalization. Market capitalization is the market value of equity shares of a company. It is an important component of a company's valuation. It is calculated as share price multiplied by the total outstanding shares of a company. Let us look with the help of an example. ABC Limited shares are trading at $15 per share. The total outstanding shares are 1,000. What is ABC's market capitalization? As discussed, market capitalization is share price of a company multiplied by the total outstanding shares. In this case, the share price of ABC Limited is $15 and the total outstanding shares are 1,000. So market capitalization of ABC is equal to $15 multiplied by 1,000, which is equal to $15,000. This means that if a person wants to buy 100% stake of the company, he will have to pay $15,000. Market capitalization is the price at which a company's equity stake can be bought or sold. Let us move to the enterprise value. What is enterprise value? Enterprise value is a measure of total value of a company. While market capitalization is a measure of value from equity shareholders' perspective, enterprise value is a measure of total value of the company's business from perspective of all its owners, whether it is financed by equity or debt or a mix of equity and debt. The ownership interest of both the debt and equity financiers are included in enterprise value of a company. In other words, enterprise value or EV is a more accurate and comprehensive measure of a company's value as compared to market capitalization. Now let's discuss how to calculate enterprise value of a company. Enterprise value includes the market capitalization or market value of equity, market value of preference share of the company, total debt of the company, short-term and long-term non-operating liabilities, market value of minority interest, less cash and cash equivalent, and value of other long-term investment in company's books. So if we add the market capitalization, the market value of preference share, total debt, short-term and long-term non-operating liabilities, the market value of minority interest, less the value of cash and cash equivalent and other long-term investments, we get the enterprise value of the company. Let's discuss each of the component one by one. Market capitalization, as discussed earlier, is the share price of the company multiplied by the total number of outstanding shares. The market value of the preference share again is the share price or the market share price of the preference share multiplied by the number of outstanding preference shares. If the preference shares are not listed, then we can treat them as debt equivalent. The total debt includes both the short-term and long-term debt of the company. Short-term and long-term non-operating liabilities are liabilities such as pension, post-retirement benefit obligations, asset retirement liabilities, which are of a nature of financing liabilities. Such liabilities usually are not related to day-to-day operations of the company and hence are treated as financing liability. Such liabilities are debt equivalent and hence included in calculating the enterprise value of a company. Market value of minority interest is the ownership of in subsidiary companies which is held by minority shareholders. After adding these five components, we have to reduce the cash and cash equivalent in the balance sheet of the company and long-term investments because companies usually invest surplus funds in buying equity of other companies or investing in some other securities. So these are like cash equivalent for the company, and so we have to reduce the other long-term investments as well. So summing up the five components and then reducing cash and cash equivalent and long-term investments give us the enterprise value of the company. Let us look at an example. ABC Limited shares are trading at $15 per share on 31st March 2020. The total number of outstanding shares are 1,000 and the balance sheet of the company is given. So company's balance sheet includes cash and cash equivalent of 100, inventory, accounts receivable, other current assets, and we have property, plant and equipment, investments, and other long-term assets which are on the asset side. On the liability side, we have current debt, accounts payable, other current liabilities. Then under non-current liabilities, we have debt, deferred tax liabilities, other long-term liabilities, which are mainly pension liabilities of 50, and then equity shares or equity investment of 1,000. So we are required to calculate the enterprise value of ABC Limited. If we recall how to calculate the enterprise value, we will start first with the market value of ABC, the market capitalization. So market capitalization of ABC is 15,000, which is the current share price multiplied by the number of outstanding shares. Then we have the total debt, which is a sum of short-term debt, which is 200, and long-term debt, which is $1,500. So the total debt in company's books is $1,700. The third item is other long-term non-operating liabilities, which are the pension liabilities we discussed of 50. Then we reduce a cash and cash equivalent of 100 and long-term investment of 520. The value of preference share and minority interest in ABC's books is 0. So summing up the market capitalization, debt, non-operating liabilities, and then reducing the cash and cash equivalent, other investments give us the enterprise value of $16,130 for ABC Limited. So this is how we can calculate the enterprise value of the company. So if we look at the calculation, we see that we have included the value of both equity and debt while calculating the enterprise value. Now let's discuss where enterprise value is used. Enterprise value is generally used at three places. First place where it is used is for measuring the value of a company or business for making acquisition or divestment decisions. Second is for making valuation comparison across companies. And the third is for financial modeling. Enterprise value is generally used to measure a value of the company or business for making acquisitions or divestment. The acquirer would be liable to pay both to the equity as well as debt financiers. That is why EV is used in making merger and acquisition decisions. Equity multiples like the PE ratio and enterprise value multiples like EV EBITDA and EV EBIT, etc., are generally used to compare the valuation of companies in same or different industries. The problem with equity multiples is that they are impacted by non-operating income and expenses and financing decisions. Therefore, two companies having different financing structure and same operating performance may have different PE multiples. EV multiples are a better version compared to equity multiples as they are not impacted by financing decisions and non-operating income and expenses. EV measures the full value of the business of the company, and EBITDA and EBIT measures the operating performance of the company. Therefore, EV multiples generally give a better picture of valuation of two companies having different capital structures. Enterprise value is also used in financial modeling. Analysts often model free cash flows to firm, which is the cash flow to 100% owners of a company. Present value of cash flows till perpetuity determines the enterprise value of the company. Let us discuss how to derive share price in financial modeling. The present value of free cash flows to the firm is enterprise value. From enterprise value, we reduce the market value of preference shares and minority interest. We also reduce the total debt, which is a sum of short-term debt and long-term debt in company's books. Then we reduce short-term and long-term non-operating liabilities, which are of financial nature. Then add cash and cash equivalent and long-term investments. So once we make these adjustments to the enterprise value, we get the value of the equity shares based on discounted free cash flow method. The value of the equity based on discounted free cash flow method when divided by the number of outstanding shares, so we get the value per share. Analysts use this method to come to a DCF value per share and then compares it with the current share price of the company to determine whether a company is under or overvalued. So enterprise value is used to compare the valuation of companies and also in financial modeling. Hope you enjoyed the session. Thank you.